All right, hold on to your hats. We are going into chapter 5 now, and I'm going to kind of blow your mind here because this is going to really increase your knowledge of accounting. So I want you to look at this, this T account here. And this is for a lady named Eve Boa, and it's her capital account. So we have our opening capital balance, and these T account entries are for the month of January. And so she's had these credit entries that increase her capital account, and she's had these debit entries that have decreased her capital account. Because up until this point, we've been recording all of our sales and all of our expenses as well as all the owner's withdrawals into this capital account. So now that we've looked at this, I want to ask you a couple of questions. Based on this information, how much revenue or how much money did the company earn in the month of January? Now you might think we could total these up, these credits or these increases, and that might be the right answer. But what if the owner invested some money in the business? So we don't know exactly how much they earned and how much was invested by the owner. The next question is how much did the owner withdraw for his personal use? So with these expenses over here, okay, what did the owner take out? And finally, what was spent on expenses? The owner would want to know that. And so, you know, is this the rent? You know, is this one here the I don't know, wages for the month? Is this here who knows, right? And so the owner would want to know these things. So to date, we have been using owner's equity to record the revenues or sales of a business, the expenses, and the owner's withdrawals. We're now going to expand the ledger, add 3 new classes of accounts in the ledger. And so that's going to include now revenue, expenses, and drawings, which is really considered the owner's salary. So drawings are the owner's salary or the owner's withdrawals from the company. And now these things are all going to have their own T accounts. We're going to add their own T accounts, and they'll no longer be recorded in capital. So this is really important. We're no longer going to record any of these things in the capital account. No more. So let's talk about these things. The first one is revenue. What is revenue? Well, revenue is the amounts that are related to the sale of goods or services. So anytime now the company makes a sale, we're going to record that sale in a new T account called revenue. Expenses. These are costs related to earning revenue. So these are the things that help us run our business. So utilities like hydro and gas. Okay, those are utilities. Any advertising costs, car repairs or repairs to equipment, wages, and the list goes on. It could be a whole number of things. We could have a cell phone. Okay, we could have rent, and we can have a whole bunch of things. And finally, we have drawings. And like I said before, drawings might be a new term for some of you. It is the owner's withdrawals for their own personal use. You can consider it owner salaries. And so we want to keep track of that in its own T account. So each of these items will have their own T accounts. So here's our list of accounts. You know your asset accounts already. You know your liability accounts already. And in owner's equity, we only had this one account to start with. But now we're going to add these accounts. So we're going to add a drawings account. And then revenue is actually a category. And within revenue, we're going to have a new T account called fees earned, okay, which is where we're going to record all of our sales. Okay, this is where we're going to record all of our sales. And then we're going to have a bunch of expense accounts, and this could be any number of things in this situation. I said advertising, rent, car repairs, wages, but it could be a whole host of things. So now our ledger is going to look a little different. Before, we used to record everything in capital, but now we have our drawings account. We have our revenue account, which is called fees earned. Okay, this is a revenue account. And we have all of our expenses. Okay, and we're going to always have a whole number of expense accounts. So now we know what we've spent our money on. So, oh no, I'm not going to be able to delete this. Hold on, let me see. I don't know. Okay, so I'm just going to go over top of it. So the question now is, how much, oh, I know what I can do. Oh no, sorry. So I can't delete that. So now we've got these separate accounts, so we can ask these questions again. How much revenue did the company earn in the month of January? Well, we can see that number now. They earned $23,660 in revenue. How much did the owner withdraw for his personal use? Well, we got that information over here. So this was just that first item, and it was his drawings, or how much he took out for personal use. So we can answer that question now. And finally, what was spent on expenses? Well, we spent some on advertising, we spent some on car expense, we spent some on rent, we spent some on sundry, which is a miscellaneous. This is the same as saying miscellaneous. It's maybe for stamps or stationery or something like that. And then we have wages. So this is what we spent our money on. And so that would be important information for the users. So now our trial balance is going to be bigger. So before we used to just have our assets, our assets, okay, so our assets, our liabilities, and our owner's equity. But now we've got our assets, okay, our liabilities, and now we have all of these new accounts that represent owner's equity. And we list them like this. Capital goes first, then drawings, then revenue, which is called fees earned, and then we list our expenses. Notice that our expenses are listed in alpha order. Okay, it's alpha order there. So let's think about accounting for revenue. Revenue is earned when a service is prepared or when goods are sold. So I want you to think about revenue along these lines. What's revenue going to do to owner's equity? Well, revenue is an increase to equity. Anytime we sell something, that's going to increase equity. And we know that equity increases on the credit side. And so therefore, revenue is credited. So revenue is always going to have a credit balance. Okay? So revenue is always going to have a credit balance. Now let's look at expenses. Expenses are the costs associated with producing revenue. So these are the things that we spend money on that actually reduce our owner's equity. These include such things like we said, rent, wages, utilities, and advertising. So I want you to think about this along these lines. Expenses represent a decrease in equity, right? So they decrease equity. We know that equity requires a decrease in equity requires a debit entry to capital. Therefore, expenses always have a debit entry. So debit balance, and they always have only debit entries. Only debit entries, okay, in their T accounts. And then finally, drawings. Like I said before, drawings is the wage for the owner. Okay, so it's a wage for the owner. And the business, so if the business is profitable, the owner can take money out of the business for their own personal use, which is called drawings. This represents, when the owner takes money out of the business, this represents a decrease in owner's equity. And we know that a decrease in owner's equity is a debit to owner's equity. Therefore, drawings is going to have a debit entry. Drawings has nothing to do with net income. So we're going to learn about an income statement here, and it does not have anything to do with net income. Okay, so it's not seen in net income. Drawings is found on the balance sheet. So we're going to see this account on the balance sheet shortly, later on in chapter 5. Okay, so it's on the balance sheet. So now, in summary, here's what it looks like in T accounts. So revenue, like I said, has a credit side. Expenses have debit side. And drawings are on the debit side. And that's just to reflect the impact on how they would look in the capital account. So now there are 4 types of accounts in the equity section. We have our capital account, which has its opening balance. And the only time it will be changing now is when the owner decides to invest their own money into the business. Okay, so that's the only time we're going to have entries now in the capital account. We have our revenue, which increases equity and therefore has a credit balance. We have expenses, and these decrease equity, so they have a debit balance. And finally, drawings, which also decreases equity and has a debit balance. So now we can prepare an income statement. So here's what an income statement is. It's another financial statement. So now we have a balance sheet, and now we're going to have an income statement. So it's a financial statement that summarizes the revenue and expenses and provides the net income, how much money the company made or how much money the company lost for a given fiscal period. And usually that's for 1 year. Okay, but sometimes it could be a monthly income as well. So we can prepare an income statement monthly, or we can complete one annually or once a year. So here's what an income statement looks like. So our trial balance over here that we just looked at, which lists all of our accounts and checks that debits do equal credits. Once that is complete, we can take all of these accounts, the revenues and the expenses, and we can create an income statement. So here is the who, the what, and the when. And then we're going to have a heading. Okay, you don't have to underline them, but a heading called revenue, and under revenue you're going to have the name of your account, which is called fees earned. And we're going to record the fees earned in the second column. Then we're going to list our expenses, again, alpha order here. Okay, and we're going to put them in the first column, and we're going to list them, and we're going to total them. So the total of these is right here. Okay, so if I was to add up all of these, it would equal $15,451. So then we take our revenue, subtract our expenses to get net income. So write that down. Revenue minus expense is equals net income. And if expenses are larger than revenue, then we will have a net loss. So who uses an income statement? Well, for sure, the owners and managers. They want to know how much profit the company is making or how much income the company is making, and are they reaching their goals? The banks are also going to want to see the income statement. They want to see if the company is making enough money to pay back their loan. And finally, the tax authorities. So the government is going to want to know how much tax does the company owe, and that's always based on their net income. So now we're going to create what we call a chart of accounts. So we're going to basically give every account a number. Accountants like to be super organized. And so what they do to stay super organized is they have a chart of accounts that lists the ledger accounts or the T accounts and their numbers. They're arranged in what we call ledger order. So assets, so if I'm the bank account, I might have number 100, and if I'm accounts receivable, maybe 110, and equipment, maybe that's 150, and so on. But every asset account is going to start with the number 1. Every liability account is going to be given a number between 200 and 299. So we know if it's a liability, if it has a 2 in the front. Capital and drawings will have a number 3 in front. Revenue will have a number 4. And finally, expenses will have a number 5. And this is just an ordering system so that we can keep track of our accounts in numerical order. So what does that look like? Well, here's that same company, Eva Boa, and here's her chart of accounts. And so she's listed all of her accounts here. So she's got her asset accounts, and they all start with the number 100. Our liabilities account here, equity, revenue, and then finally expenses all start with the number 5. Okay? All right, thank you for listening.